Good afternoon and welcome to the AUDIOBOOM Group PLC Investor Update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Stuart Last, CEO. Good afternoon, sir.
Thanks, Alessandro. Welcome, everyone. I'm glad you can be back with us for an update on our Q1 trading. We have a lot to get through today, so we'll move pretty quickly into it. But just a reminder to submit those questions, and we'll get to those towards the end of the presentation. Quick intros, as always, first from Brad and myself, just for anyone that is new to the business and hasn't met us before. My name is Stuart Last. I'm the CEO of AUDIOBOOM and have been in that role for the past 3 years. Previously, as COO of the company, I launched the business in the US. Back in 2015, I have a history in audio and digital audio. I previously worked at the podcast ad tech company Voxnest, based here in New York City. And before coming to the US, I was an executive at the BBC and BBC Radio, delivering their digital strategy. So long history in digital audio, and just, I think, really enjoying my time as CEO of AUDIOBOOM. We have a great company here. We're making really fantastic progress, and we have a good future ahead of us.
Hi everyone, I'm Brad, CFO here at AUDIOBOOM. I've been here since March 2018, so into year 6 now. Chartered accountant, 15 years of experience in various finance functions at media companies. Started off at Grant Thornton, then went to Brave Bison, News UK before joining AUDIOBOOM. So yeah, let's get into the presentation, Stuart.
Thanks, Brad. As always, for those of you that already know the business and have been with AUDIOBOOM for a long time, I just ask that you're patient through this first section where we lay out the business model, talk about what the company does and how we operate. Some of that you will already know, but it's great for those that are joining us new or relatively new to the company to go through that. And obviously, there's always things that in there that you may learn anyway. Part 2 of this, we'll look at our Q1 trading. We'll break down the numbers. We'll look at our operational progress in there, and then finally, before we get onto your questions, we will look ahead to the future, talk about what we're focused on and how we're moving the business forward. So let's dive right in and look at the model and the operations. I think the first thing to say is that you'll no doubt be aware at this point that we are working in a pretty weak advertising market, and AUDIOBOOM is our revenue does come from advertising. And I think while the market is perhaps in the short term growing a little slower at this point than previously projected, I think we have to all look forward to 2030, when the industry and the total addressable market for podcasting will quadruple. So today, globally, podcasting is worth around $4 billion. By 2030, that same industry will be worth around $16 billion. So the industry, the market will grow on average at 22% a year over the next 7 years. So despite this short-term slowdown and the headwinds in the advertising market, the projections for podcasting are still very strong. And AUDIOBOOM is fantastically positioned to make the most of that growth and to grab market share. We are the leading independent pure play platform globally. And as I'll show you on the next few slides, we're growing faster than the industry as a whole, and as I said, just well positioned, well placed to really capitalize on the growth of that total addressable market in podcasting over the next 7 years. This is AUDIOBOOM against the industry. To put that into some kind of context, on the left-hand side, you're seeing AUDIOBOOM's growth against the US market's growth. We grew at 25% last year, and significantly outperformed the full year growth of 15%. We have now outperformed the US market growth every year for the past 6 years. And in that time, we've taken our market share from less than 2% to more than 6%. So again, our business model, our focus is really allowing us to capitalize on the growth in the industry, but also to grow faster and to gain that market share. The chart on the right is the ranker of all podcast publishers in the US, and AudioBoom is the 5th largest publisher in the US. Again, something we are immensely proud of, the position we've been able to take there. We have strong competition from some major media organizations, Amazon, Audible, iHeart, Spotify, Sirius are the only ones ahead of us in the US. So to do this as a small independent company really just highlights the strength of our business model and why being a pure play podcast operator is so impactful right now. So to sum up those last 2 slides, some strong growth for the industry ahead of us. AudioBoom will move faster than that. We will gain market share, and we're in a great position as the leading pure play to capitalize on that growth. Our business model is based around bringing 3 key elements of podcasting together and extracting value from bringing those elements together. So our platform will connect creators and their content with audience and then with advertisers. And the only value in podcasting is by putting those 3 together. So it's good to have great content, but unless you have audience attached to that content, then advertisers are not interested. And so by bringing the 3 together, we're able to extract value for creators and advertisers and distribute widely to audiences globally. AudioBoom believes in 3 things. First one being that this is an independent creator medium. So podcasting won't be led by major media organizations. Podcasting will be led with authentic, independent creators. Our platform works great for independent creators. We allow them to monetize, to distribute, and extract that value from their content. Our second belief is that this is an ad-funded business, an ad-funded industry. Podcasting does not have any of the legacy issues of, let's say, TV with the cost of cable, things being only available in a linear fashion. There is no real need for subscription or monthly payments for podcast content. There's great content widely available, ad supported, and the audience expects their content to be free at the point of listening. And then thirdly, we believe in podcasting being a distributed media, which means that we put the content and we place that content everywhere the audience can hear it. So there's no exclusivity there. We're distributing that content out to Spotify, YouTube, Apple Podcasts, Pandora, iHeartMedia, and many other listening destinations. So those 3 core beliefs drive the business model, and the business model is based around connecting 3 key elements together to deliver that value. And our mission as a business, as it states very clearly on our website, is to power podcasting for creators and brands, and we do that very successfully. Since 2018, we've delivered more than $150 million to independent podcast creators. And we've delivered and executed more than $200 million worth of advertising campaigns for our customers and the brands that we work with. So we have a strong business, successful business moving forward based around a business model that is allowing us to gain market share and move faster than any of our competitors. That business model is underpinned by our technology platform. It's the AudioBoom technology platform that sits at the heart of our business and allows for the scalability and the monetization to really flow. So just to walk you through the key elements of that technology platform, at the core is a creator platform. This is allowing our creators to publish their content. It gives them a bunch of tools to successfully plan and publish their content. It hosts the audio and distributes that audio out to all of those listening destinations. And then it gathers the analytics and the data back, consolidates those analytics in a dashboard, both for the creators, but also for our advertising and monetization teams to go out and successfully monetize that content. On top of the creator platform, we've built an advertising technology stack. So that's an ad server, a yield ops system that gathers the best pricing in real time for that advertising inventory. Inventory creation tools like AdRip, which we'll talk about a little bit later, and then our automated advertising marketplace, which we call Showcase, which launched almost 2 years ago now, and is the fastest growing part of the AudioBoom business. So we believe in a tech-based advertising platform on top of our creator toolset. And then thirdly, we have layered on top of that a Salesforce-based and a bespoke Salesforce-built inventory management system that we call Lyrical. This is giving us incredible business and sales intelligence around how we sell and deliver advertising and gain the best pricing. It automates our billing process. It really drives every aspect of what AudioBoom does. It allows us to be very lean with a very small headcount, and has really changed the focus of the business since we launched that inventory management system around 4 years ago. So that's the tech stack, that's the platform at the heart of all of this. And on top of that, we now have some real global scale to the content that runs through that platform. So we have more than 8,000 podcast channels from independent podcast creators. That content is downloaded more than 130 million times per month, and we reach 38 million unique listeners around the world each month as well. So the platform is fully scalable. It doesn't require vast investment to create that scale. And as I said, we have some really great content and some really great numbers running through that platform today. Quick slide just on the content that's running through that platform and a little more detail there. We have 8,000 shows in total, as I mentioned. Within that 8,000 podcast channels, we have around 200 podcasts that form our premium network. These are some of the biggest shows available globally. They have large audiences, 1 million plus in some cases, audience size, and they are a real driver of advertising revenue. Within that premium network, there is also AudioBoom Studios. Those are shows that we are producing or co-producing or creating in-house from our production units in New York and London. It's a smaller set of shows, around about 30 podcasts. And then there is the long tail of content, the other 8,000 podcasts, much smaller shows from independent creators, but they drive great volume when they come together through our network and through our platform. The next slide looks at our revenue lines, our revenue products, and the three key products being our premium advertising, Showcase, which is our automated marketplace, and Sonic. I'll talk about each one of those in a little more detail, starting with our premium ad product. You'll recognize this from any podcast listening you do. Our premium ad product are host endorsements, endorsements for products that are voiced by the host of the show with high engagement and therefore very high pricing that comes with those. We sell those premium ad units in-house directly to advertisers and brands through our in-house sales teams. And we're able to sell those against our top 200 shows because those shows are large enough for us to gain that advertiser attention. The premium ads are still the bulk of our revenue, at 60% of our revenue in Q1 of 2023. And they come with a revenue share to us of 21%. So we do revenue share deals with our podcast creators for our premium advertising. That revenue share is at 21% currently. Showcase, as I mentioned before, is our automated advertising marketplace, the advertising that runs through our ad tech stack. Again, this is on our top 200 shows, but also in our wider 8,000 podcasts, the long tail of podcasts as well. So we have the scale running through the entire group of podcasts. This is an automated sales process. We're not selling those ads directly in-house. We're using the tech connections and the tech platform to monetize the advertising inventory that flows into Showcase. And it's something we'll talk about later in the slide, but it is the fastest growing part of this business. We launched Showcase 2 years ago, and in Q1 of 2023, it made up 20% of the company's revenue. A year ago, it was only delivering 11% of the company's revenue. So fast growing part of the business, and as we look to the future, Showcase will continue to be that fast growing part of AudioBoom. And then Sonic, the third part of our advertising business. Sonic is a brand platform that works directly with advertisers and allows those brands and helps those brands to deliver and execute their advertising campaigns in podcasting. Sonic has been part of the AudioBoom group for the past 4 years and has grown quickly to become 20% of our revenue contribution. Has that slimmer revenue share attached to it as it works directly with the brands and on behalf of brands rather than directly with the content creators and the podcasts. And as you'll have seen, if you've been with us for the last few presentations, we are increasing that revenue share with Sonic. Has previously been 10 to 11%, and we're over time making that more favorable to AudioBoom. So that should give you a good overview of the 3 revenue lines within the group, how they're performing, how they're growing, and the revenue shares that AudioBoom sees from each of those. So hopefully that first section has given you a good look at the business, the industry that we're in, why we are able to grow faster than the wider industry, and what we have ahead of us, and what opportunity that we have. This second part will focus more on our financial results in Q1 and the operational progress that we have been making in the background since we all last spoke. First slide, I will just walk you through this one to start with, and we'll go into more detail on it in upcoming slides and with Brad shortly. But the headlines, I think, from our Q1 2023 trading update that went up this morning are this: $15.4 million of revenue in Q1, and that's down from the 19.5 in Q1 of last year. And again, we'll get into this as we go, but that is due to the ad market weakness that's currently in play because of the macroeconomic downturn that we've seen over the last 9 months, and against a backdrop a year ago of an extremely buoyant advertising market. So real extremes at this point, probably the most buoyant advertising market that I've ever experienced a year ago versus a very tough advertising market today, and that's really been the impact on that revenue by around 20% is linked to that advertising market. Our adjusted EBITDA profit of $0.2 million, again down from Q1 of last year. EBITDA impacted by the lower revenue because of the ad market, minimum guarantee payments that we have to deliver to our podcast partners despite the lower revenue. And then some inflationary pressures on OPEX that we're dealing with very, very well, actually. And you'll see in Brad's slides that we are managing our costs extremely well. But nonetheless, in these inflationary times, we do have pressures on that OPEX too. So $0.2 million of adjusted EBITDA profit in that time. And we have $5.1 million of cash currently, although we have, as you'll have seen on the trading update, collected more than $3 million above that number since the end of the last month. So that $5.1 million of cash is obviously down from the end of last year. In Q1 of each year, we have some sizable advance payments that we make to our podcasters, our top podcasters. Some of those deals that we have there involve an advance against their revenue. Those advances are recoupable, so we expect to make and recoup that advance payment against the podcast over the lifetime of the contract. So while cash goes out of the door somewhat heavily in Q1, we do expect to recoup that against sales over the contract. As you'll have seen in previous RNSs, we are proposing a progressive dividend for 2023, payable in 2024, because we feel strongly that we're in a good position around cash. We have enough cash to continue our growth and to fund our operations, and we are planning our maiden dividend for 2023. And then just to say, we still have an additional $1.8 million available to us in an overdraft that is untouched. So a very healthy cash position still, and we'll go into a little more detail now on the revenue and EBITDA numbers from Q1. So to analyze that revenue, and I spoke a little moment ago about how we believe the ad market has impacted that revenue number by more than 20%. I just want to highlight two of our KPIs that we show to you every quarter. The first one being global downloads, the second one being our eCPM, which is the value that we extract from those downloads. So I think first note here is that our global downloads number of 125 million downloads per month is very much in line with Q1 a year ago at 126. Now, in that time, we lost the Morbid podcast from our network, and with it, we lost around 30 million monthly downloads that show was delivering. We have now fully replaced all of those downloads. So we are back to around 125 million downloads per month, which I think is a fantastic effort over the 9 months since that show left us to fully replace such a large show. We're back to that download number of around 125 million. So we have the same number of downloads, but we have lower revenue. And that's because our eCPM, the value that we extract from each of those downloads, is down versus last year. eCPM for Q1 was around $41. A year ago, that eCPM was around $49 to $50. And historically, during the strong ad market, that eCPM was around $50 to $55 dollars. So obviously, that eCPM is down because pricing is low in the short term. The pricing that we can get from advertisers is low in the short term, and the demand for advertising slots and advertising spots is low in the short term from advertisers. So that impacts the eCPM, and the roll-on effect there is with the global downloads number of 125 million. We come out around 20% lower than we did a year ago based on a very similar downloads number. So the ad market is tough right now. It is weak. Pricing is lower. Demand is lower. And on like-for-like consumption, that weak ad market has impacted our revenue by more than 20% in Q1. But we are focused on improving that revenue, obviously, and we have some changes that we are making within our advertising sales in-house teams to counteract that weak advertising market. So I think the first thing to highlight is the number of brands and advertisers that we work with currently. We have almost doubled the number of advertisers from a year ago, and much of that brand count growth has been delivered through Showcase, and Showcase has been responsible for bringing in new advertisers because of the automation and the ad tech that's in Showcase. It makes it very easy for advertisers to plan their campaigns and execute their campaigns, and they can do that with lower budgets and lower commitments to podcasting, which is very important in a weak advertiser market. But in Q2 of this year, we are focused on the launch of a new revenue unit within the business. This revenue unit will access brand awareness advertisers. So currently, podcasting, and previously, I should say, podcasting has really been built around performance marketing, performance brands. Those are disruptive, often new direct-to-consumer brands that that measure ROI directly from podcasting, and have shown strong commitment to podcasting. You'll see those brands on the top right there, brands like SimpliSafe, HelloFresh, ZipRecruiter. We do a great job with those customers, and we deliver great value for those customers. But the new unit will start to access budgets from larger, more established brands, brand awareness, we call them. So they are not directly measuring the performance of their podcast advertising. Their advertising is about building awareness of their brand. So that could be companies like Ford, Nike, Procter & Gamble, Pepsi, as examples. So they have bigger budgets, they're more mature, they're more established, and they're impacted less by these downturns in the advertising market. That will be incremental revenue. It doesn't cannibalize the current sales inventory that we have. All it does is it adds to the overall demand and overall fill rates for that inventory. And from launch until the end of the year, that new unit will have a 5% revenue goal. So we expect them to deliver 5% of our overall revenue for 2023, despite not launching until later this month. That will increase our eCPM and grow our revenue across the year. Another improvement that we are making to improve that revenue is with our advertising inventory. So again, this is about extracting more value from the content that we do have on the platform. So if you can compare the numbers here, I've shown you previously that the average monthly downloads across this quarter and the same quarter a year ago were similar, and you'll see that here in Q1 of 2022 we had a total of 378 million downloads. Very close in Q1 of this year at 375 million downloads. But you'll see the real difference there in the number of available advertising impressions that we have made available from those downloads. So a year ago, it was just under 2 billion available ad impressions. And this Q1, we made over 2.5 billion available ad impressions. And so you'll see that the ratio down there at the bottom, we were just making 5.2 ad slots available per episode, and now we make 6.7 ad slots available per episode. So we're increasing the level of sales inventory from the same number of downloads. We've increased that by more than 25% since Q1 of last year. We do that in a variety of ways. We are updating contracts that we have with our creators to make more advertising available. We launched a tool called AdRip around 18 months ago, and the adoption of that from our creators has led to those higher impression numbers. We continue to work with our creators around advertising best practice and build out the layers of our ad tech and automation. So this one will continue. This piece of work will continue. We'll continue to extract more available ad impressions from the content that flows through our platform. And as the advertising market returns, that will enable us to really gear that revenue up and as we grow and show some strong revenue growth across the rest of the year and beyond. That downloads to inventory ratio of 6.7, we do expect that to continue to grow across 2023. To focus on some more operational improvements, and I think one of the key messaging here behind this is, although we are not seeing it in our financial numbers in Q1, the operational progress is there in the background, as I've just shown on the last two slides. More operational progress to show off here. And again, when that ad market does return, what I want to make sure is that we have done everything that we can with the things that we can control, the operations that we can control to fully capitalize on that return in the advertising market. So another one of those operational changes is the improvement in our advertising revenue shares. Again, through contract renewals, new contracts with our podcast creators, we've increased our network-wide advertising revenue share to 24%, up from 21% in 2021. Those more favorable creator contracts will begin to flow through the P&L as the ad market improves. It will improve our gross margin. It will improve our EBITDA as the advertising market recovers. So good progress there on our advertising revenue shares. We talked a little bit about download numbers, but we have record audience reach as well. So in March, we reached a record 38 million unique monthly listeners globally. That is important because although the download numbers are similar to a year ago, we are doing this through a wider group of monthly listeners. So the downloads are spread out across 38 million listeners rather than 32, and that helps advertisers execute their campaigns. They need to be able to spread those campaigns out against a wider audience reach, and again, that will help us as the advertising market continues to recover. We've further grown our creator network, so we continue to add new podcasts into that creator network. That adds audience, that adds advertising inventory. So you'll have seen recent announcements about new multi-year deals with shows like Net Worth and Chill and Stan Report with Brittany Broski. We expect those to be good contributors to our revenue over the rest of the year. And we've done a great job, I think, as well across this year and last at renewing our contracts with some of our key shows. And just recently, we have renewed deals with Tiny Meat Gang, Astonishing Legends, Speak the Truth. Those are all top 20 shows on the AudioBoom network. So we continue to grow that creator network and the footprint of that and the advertising opportunity that comes with it. Formula One partnership just got renewed. I hope that you've all seen that. That's a fantastic partnership for us. We will co-produce the official Formula One podcasts. We will provide them with their technology and their distribution and commercial services as well. So that Formula One podcast is now in its 4th year. It's great for us. They're a really fantastic partner of ours. And that partnership, I think, just really highlights all of the elements of the AudioBoom platform more than any other partnership, perhaps. You know, we co-produce that content with them. We provide them their technology and the distribution. We sell advertising on their behalf into those podcasts. So really every element of the AudioBoom platform and business is utilized in that Formula One partnership. And I'm very happy that we have renewed that for the next few years. Also recently renewed is a commercial partnership that we have with the Australian Radio Network to monetize our ad inventory in Australia. That is our 4th largest region for consumption after US, UK and Canada, and comes with a revenue commitment from ARN so that we are confident of our revenue in that 4th largest consumption region over the next 2 years. And then finally, we've touched on it before here, but just to reiterate the strong growth in Showcase, revenue from Showcase in Q1 was 47% greater than a year ago. And as I've shown you, it contributes around 20% of the group's revenue. So very fast growing area of the business. We expect that to continue to grow quickly, and the launch of that new revenue unit that I talked about, that brand awareness revenue unit within AudioBoom, will flow through into the growth of Showcase as well across the rest of the year. So Showcase is doing great, and a real win for us and a real strong operational part of the business in Showcase. So that's the operational improvements. As I said, they will begin to flow through the business as the ad market recovers. But I'll throw to Brad now, who's going to do a deeper look at the finance.
Cool. Thanks, Stuart. Hi, everyone again. So yeah, the next few slides, if you've tuned in before to these presentations, has got a familiar feel to them, but there's some good data points to draw out from Q1. So yeah, we can see our financial progression over the last 6 years here as we've positioned ourselves among the leading companies in the podcast industry. We can see that compound annual growth of revenue at 59% between 2018 and 2022. So really good, strong top line growth there across the company. As expected, we announced this morning a Q1 revenue of 15.4 million. That was in line with our expectations for Q1. Obviously, we've got those global macroeconomic pressures in the ad market currently having an impact. And also we didn't have the Morbid podcast in the network either. So Morbid accounted for 4.1 million of revenue in the first quarter of last year. So removing that Q1 2022 was also at 15.4 million. In terms of the EBITDA, the cost control, we'll come to that in a lot more detail shortly. But the cost control across the company has again allowed us to continue to report on adjusted EBITDA profit for the first quarter. We continue to demonstrate to the rest of the podcast and wider tech markets that it's possible to generate profits from this industry if you align your cost base appropriately, and that's something that we absolutely do. Again, to repeat, 2022 was our strongest year yet. Revenue increased by 25%, record EBITDA, record cash generation, and we expect 2023 to be a year of growth once again above that of the wider podcast market. In terms of revenue and costs, we can see that revenue trend over the last couple of years. Again, we've been through the revenue of the first quarter being in line with our expectations. It's good. Stuart's highlighted the good growth across Showcase, 47% growth year on year, contribution increasing from 11 to 20% of that very healthy gross margin of 42%. So it'd be good to see that progress as we go forward. Sonic Q1 revenue was also in line with Q1 last year at 3.1 million. The cost base that we have, I've said before, that flexes with, we said it in the announcement this morning as well, that flexes with business performance. So if you view the OPEX over the last 13 quarters that we've got detailed on the page here, obviously there's variances, but that has varied in relation to the performance of the business. The actual average OPEX over those 13 quarters is 2.4 million, and it doesn't really move significantly too far away from that number on a quarterly basis. So Q1 OPEX was 14% lower than in the first quarter last year, so 2.7 million versus 3.1. Q4 OPEX was lower again at 2.1 million. We had some accrual releases that we processed in the fourth quarter of last year, mainly across the staff cost line due to lower incentive remuneration because of the performance of last year. 60% of the OPEX continues to relate to staff costs and commissions. That actually reduced 20% quarter on quarter, and we achieved that by reducing headcount by year on year. So we're now at 39 heads. We're actually at 44 at the end of December, so 5 heads taken out of the business in January, and we also incurred lower sales commissions because of the lower revenue recognised versus a year ago. Technology costs, that's the second biggest cost bracket in the company. That has actually increased year on year by 21%. That's because of those high level of impressions and the high bandwidth that we're incurring. What we've actually done in terms of the material costs within that cost bracket is renegotiated the contract for the impressions and bandwidth. So on a like-for-like basis, we managed to achieve we estimate that we would achieve between a 12 and 15% saving. However, the overall cost will increase because obviously, as Stuart has outlined, we are increasing the bandwidth and the advertising impressions across the business, but the overall like-for-like cost, we're expecting reductions there, and that work's being done for in preparation for when the ad market returns. So as I've said before, this isn't a business that's lumbered with high recurring costs or stock, doesn't have a high headcount. So when we are in periods of macroeconomic challenges, the cost base is well set to weather those. So yeah, hopefully that's given you a good update on the OPEX within the business, but the cost control is of utmost importance as we go forward. In terms of working capital, I guess the main point here is that obviously the cash reserves have decreased by $3 million, as Stuart mentioned earlier. Again, we expected that because of the Q1 capital requirements. Q1 always has those capital requirements. There's contracts that have advance payments that are contractually required to be paid. So we've paid around 1.2 million of recoupable advances in the first quarter. We expect to recoup those advances over the life of the contract, but that does impact working capital in that first quarter. First quarter as well, we also pay staff bonuses and Q4 sales commissions, and we pay podcaster revenue shares for that seasonally stronger fourth quarter as well. So there's a few non-recurring working capital requirements in the first quarter, but we also do have that 1.5 million multi-currency overdraft, which we expect to renew over the next month or so as well, but that's untouched at the moment. We also see, as we saw last year, that towards the end of the first quarter, particularly amongst our biggest customers, there's my sense that there's definitely a case of customers withholding their cash to preserve their own cash reserves. That's why we gave that context of the 3.6 million being collected since quarter end, a third of which came from one of our largest customers. So it's good to get that collected. We've actually collected another 200k today, so we can say that's 3.8, and that takes us through $20 million collected on a year-to-date basis. For the first quarter, 16.3 million collected, which is 106% to the Q1 revenue booked. 3-year average on that is 94%. So that's the level that we're targeting in terms of collections, is to get as close to the revenue booked total in any given quarter. Debtor days, they've increased by 10 since December, so from 68 to 78. We target here trying to get that below 90 as much as possible. Our biggest customers a couple of our biggest customers are advertising agencies who typically pay on 90 days. So the further we can get that below 90, that's our target. Maybe that's good performance in the first quarter, particularly with that withholding of cash from our biggest customers as well. And there continues to be a very low level of bad debt expense incurred first quarter, around 0.2% of revenue. So that remains a very low number as well. In terms of wider process improvements, we're always continuing to push things forward within AUDIOBOOM. So Sonic is now in a very good place, having adopted many of the financial processes that we have in AUDIOBOOM in terms of collections and payment run processes. So that entity is now working very, very efficiently. And we've just kicked off the next phase of the NetSuite implementation, which will be utilising their budgeting and planning tool, which will go live in Q3. So that's another area of improvement that we are investing in the business as well. So yeah, to wrap up these slides, financial slides, before handing back to Stuart, the business has done, in my view, a good job in terms of controlling the costs, very lean cost base. We've gone through the review of ensuring that, stripping out any unnecessary costs, it continues to remain a very lean business. Fully funded for that current growth trajectory. We've announced that progressive dividend policy as well in relation to the current fiscal, and those working capital requirements. Working capital cycle as well continues to operate as we expect, with those known pressures that we have in the first quarter as I've outlined. So thanks for listening there. I've got a few questions to go through at the end, so I'll speak to you again shortly.
Thanks, Brad. And just a reminder, probably this is the last chance to get some questions in. We have maybe 2 more slides, I think, before we get to questions. Those last 2 slides are really on future focus, and I think we've touched on many of the points there earlier when it comes to our operational progress. But in terms of future focus, there's clear areas that we're thinking about now. And this does relate, I think, to some of these top 2 here. It does relate to some of the questions that have come through around eCPM. I think many of you are recognizing that lower eCPM has caused the revenue drop off, and there's questions about how we get that eCPM back up. There's several questions there, so maybe I'll answer that now. But I think these top 2 areas of focus are designed to do that. So with eCPM down, we want new customers. We want customers that are less impacted by the current macroeconomic situation, and that's what the development of our new brand awareness revenue unit is. It's opening us up to new advertising budgets from those more mature, larger, awareness-driven advertisers. Like I said before, things like Ford and Pepsi and Procter and Gamble. As I said, we launched that this month, and the goal there is to deliver 5% of our revenue this year. So more customers, more budgets, that will increase eCPM as we go through the year. And then the second point here, value extraction, which I broke down for you earlier. The more ad impressions we're able to create from a number of downloads, the more monetization opportunity there is there. So we'll continue to to grow that ratio of available ad impressions from the downloads that we have. We'll further the use of tools like AdRip amongst our podcasters and roll out that tool set to our creators, which will and recontract with our creators so that we can deliver more value from those downloads through a higher number of advertising impressions. So those top two really are, I think, are answering those questions that have come in on eCPM and how we grow that eCPM. Again, I think one of the questions asked if we feel that the eCPM has hit its floor, and I do. I think that around 40 is the current floor on that eCPM. So expect that to grow across the rest of the year. Another area of focus is the continued expansion of our creator network. I think we are in a place where there is opportunity at this point to increase the number of top tier podcast signings. We're in a somewhat less competitive space than we were a year ago, so we can offer top creators strong contracts and beat out offers from our competitors that are more leveraged and more impacted by the advertising market downturn than we are. As always, we'll continue to focus on the growth of Showcase. It's been a growth area for us, obviously, but we think there's a long way to go with Showcase. So building out new ad tech tools, growing the number of demand side partners that we have on Showcase for the automated advertising part, and expect continued growth from Showcase over the rest of the year. And then in terms of progress for 2023, we currently have $52 million of advertising bookings in place. Historically, at the end of Q1, we've been 65% booked to the final revenue number. Now, I expect that to be a little different this year because of the weak advertising market and the lack of confidence that advertisers have had in the early part of the year. So I do expect that bookings number to be more weighted to the second part of the year as confidence returns and sentiment returns in the advertising market. But nonetheless, I think $52 million on the books today shows that there is still confidence in podcasting from brands, but I do expect that to accelerate as we get further into the year and more confidence comes into the space. So overall, that means that revenue, as you've seen in Q1, will be lower than 2022 during the first half of the year. That's the weak ad market now versus a very, very strong ad market a year ago. And then we will return to growth mode in the second half of the year. And we continue to expect that full year growth will happen in 2023. No changes there. We expect full year growth, and we expect that growth to be ahead of the wider industry to increase AudioBoom's market share. And as we've highlighted a couple of times, based on that expectation and that performance expectation, we do plan to deliver that maiden dividend in 2024 for 2023 financial year. So good progress, I think, and we're seeing some good signs that the ad market is returning. Bookings numbers and bookings cadence over the last few weeks has been strong, and we are doing everything that we can. I think that everything that we are in control of to improve the revenue across the year, as I've highlighted in those areas of focus on the last couple of slides. So that's the last slide from us. I appreciate your time as we walk through that, and we'll be back to answer some questions in just a second.
Stuart, Brad, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Stuart, Brad, as you can see, we've received a number of questions throughout today's presentation. And if I could just ask you to read out those questions and give responses where it is appropriate to do so, I'll pick up from you both at the end.
Thanks, Alessandro. The first question here was actually a pre-submitted question. It says, previously you mentioned that the subscription element of the business has gross margins over 90%, but it wasn't mentioned in the most recent presentation, and on the last presentation you didn't seem that interested in growing this element of the business. Why is that? Yeah, we've always had that subscription element of the business. In terms of revenue, the money that small podcasters pay us to use our tool set is very small. It's less than 0.5% of our overall revenue. The main reasons here for not focusing on growth of that, despite the high margins that come with it, are the relatively small addressable market for podcast toolset subscriptions. There are today around 500,000 active podcasts globally, so podcasts that are actually producing content and need that podcast tool set. That equates to around $60 million of revenue per year total globally. And it's a very competitive space. There's at least 30 hosting platforms that are dedicated to providing podcasters with a tool set. So a high number of competitors for that $60 million. And really, they all have the same product. There's very little to distinguish between those hosting platform products. The only real differentiator there is in pricing. And there are a handful of those 30 hosting platforms that actually offer a tool set for free to podcasters. So small addressable market, high number of competitors, very little to differentiate amongst those competitors, and many of them offering the service for free. It's not, it just doesn't add up to an area that we feel that we want to focus on. We feel that the growth and what we are set up to really deliver is based around podcast advertising. Second question actually relates more to our 2022 full year numbers and annual report that went out recently, but I think it's definitely one that's worth picking up on here, because I know some of the message boards have been asking questions about this one, and probably Brad, one for you to pick up on. But it says, last year you made $4.4 million of share-based payments. Can you explain what this money was used for and whether this level of share-based payment will be a continuing theme?
Yeah, as like I say, it's a common question since the publication of the annual results last month. So, yeah, I think firstly, as a public company, AUDIOBOOM has and can issue share options to staff to incentivize and retain those working for the company. It's really an important tool for us as we try and retain the talent within the company, so that we remain competitive in terms of what we offer to staff, as we know that competitors may pay more in terms of base salary. So first point is it's a really important tool to retain talent within the company. Specifically on the charge for last year, so the reason for the we should say it's non-cash, non-EBITDA impacting share-based payment charge of 4.4 million. That was largely because in May of 2022, last year, 442,000 share options were issued to staff, but they had an exercise price of £15.55, which was reflective of the share price at that point. If you head to page 55 of our annual report on our PLC website, you can see all the detail on share options there. But when calculating an appropriate charge, we need to use the Black-Scholes calculator and calculation method. And with that exercise price of £15.55, with a 442,000 options being issued, that generated a significant charge to be recognised in 2022, because those options vest over a 3-year period, and you need to recognise a third of that charge within the first year. In previous years, share-based payment charge has been lower because that share price has been lower, and options have been granted with a lower exercise price, and therefore a lower charge has been calculated. That charge will reduce over time, because the 2/3 of options that didn't vest in 2022 will vest in 2023 and 2024. So that charge is spread out over a longer period. I think to guide on this year's expected charge, last year 4.4 million, I'd expect the charge this year to be somewhere around 2.8 million, and then lower again in in 2024 in relation to those options issued last year. So yeah, we'd expect that to reduce over the next couple of years.
Thanks, Brad. We have 7 minutes, so we'll move quickly through some of these. You've mentioned losing the Morbid podcast in previous presentations, but today the impact of that is a bit more clear. Why were you unable to re-sign that show when it was clearly so important? Yeah, so Morbid is a huge show, top 5 show in the world. As I already said, 30 million downloads a month. It was generating and a big revenue contributor to AudioBoom. In the first half of last year, the advertising market was extremely buoyant, high demand, high pricing, and it meant that bidding for talent and top podcasters was highly competitive. It was a real bubble. Many of our competitors, and if you go back to one of the early slides I showed you today, some of our competitors at the top end of podcasting are Amazon and Spotify and iHeartMedia. They were willing to make huge bids for shows and be potentially loss-making immediately off the bat. Just never mind moving into a weak ad market. If AudioBoom doesn't have that luxury. We are smaller. We have to be more aware of what each of those show signings delivers to us. We can't sign shows that are immediately loss making just to look to grow in the long term. We have to be a little smarter than that. If we had have won that show, if we'd have bid high enough to renew Morbid as the ad market turned, it would have been materially loss-making for us, and would have been in a very, very tough position at this point. So while it does impact the year-on-year revenue, not having that show in the network, we are fundamentally in a stronger place without it. The revenue and the risk is spread over and more evenly spread over a much wider group of shows and across the wider network. Any plans to expand within Asia? I don't think we have hard and firm plans on the Asian market. We actually see Latin America and mainland Europe as having more opportunity in the short term. We currently have more consumption coming out of those regions. Less than 0.25% of advertising inventory that we have is coming from Asia at this point. So in the short term, not an immediate opportunity there. I don't think. We do have a partnership in India with AUDIOBOOM Studios. They are able to monetize our inventory there through Showcase. But no plans to step into there immediately. And if we do so, I think we would replicate the work that we do with ARN in Australia and Rogers Media in Canada, where we partner with a large commercial organization that are already on the ground there to monetize our content and our ad inventory that way, without us having to invest or put boots on the ground there. Maybe one for you again here, Brad. In light of delayed reporting of TR1s from certain investors, can investors feel confident that the current shareholder register is now accurate?
Yeah, lots of comments on this and surrounding issues. So I can confirm the company has published all TR1s it has received from shareholders. Those major shareholders are disclosed on our AudioBoom PLC website. I think just to add a bit more context and information on the process for people that aren't aware, shareholders that hold more than 3% of shares in a public company required to disclose their position via what's called a TR1 notification, and that is sent to the company by the shareholder. The company then publishes that on its RNS feed. We display holders of more than 3% of shares on our major shareholders page of the AudioBoom PLC website. When a shareholder goes through a percentage point, so from 3 to 4 or from 4 to 5, whatever it might be, a TR1 notification is required. But ultimately, it's the shareholder's responsibility to ensure that TR1 is filed with the company. What we do is run a regular analysis of that shareholder register, and should there ever be a circumstance where there is a difference noted between TR1 and the shares that are detailed on that register analysis, I contact the shareholder to confirm their position. The data on the register analysis can't always be relied upon because the holdings may be held over a number of accounts. However, we, rest assured, we do monitor that very, very closely and follow up with shareholders if there are any discrepancies noted. But that's an exception rather than the norm. But that's obviously something we do monitor very, very closely. But it's ultimately the shareholder's responsibility to file those TR1 notifications with the company.
Thanks, Brad. We're coming to the end of the time slot. We'll try and answer some more questions after this on the Investor Meets platform. But I think we covered off the major areas with some of those questions, Alessandro.
Yes, Stuart, Brad, thank you very much for that. I think, as you say, you've addressed those questions you can from investors. And of course, the company will review all those questions submitted today and will publish those responses on the Investor Meet company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both and the company, Stuart, could I just ask you for a few closing comments?
Yeah, I think the key focus for this business is to focus on the elements that we can control, right? Which is building the operations, improving the number of downloads, improving the number of customers, improving the level of ad inventory that we have, so that we are just primed to take full advantage of the return in the advertising market. And as you'll see in this presentation today and in the trading update, we are making great progress operationally, and it's just frustrating, I think, that it's not being reflected in the revenue and the EBITDA numbers. And the reason it's not being reflected there is because of the weakness in the advertising market. I've said that it's impacting us by more than 20% at this stage. And right now we are comparing a very weak ad market to an extremely buoyant ad market a year ago. It was in an incredibly strong place a year ago. As we move into the second half of this year, we will see an improvement in the current ad market, and we will be comparing against a year ago as the ad market dropped off. So when you look at that, we're doing all the right things. We're seeing a recovery in the ad market. We will have H2 growth. We will return to growth mode in the second half of the year as we do this. And overall, again, we continue to expect that this full year for AudioBoom will be a year of growth. It will be a year of growth that is ahead of the wider industry, and we will gain more market share and kind of continue that mission, I think, to be the biggest pure play podcasting company in the world.
Stuart, Brad, thanks once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of AudioBoom Group PLC, we'd like to thank you for attending today's presentation. Good afternoon to you all.